Hey,
Hey, Howard.
wanted to do a Panic with Friends video version today. Uh, I'm, I'm maybe because I'm in the corner of the world of Phoenix and my Alan's got me in the corner of the house. I'm not in a panic mode, or maybe it's because I've been pretty conservative. But people are panicking, and I figured this would be time to panic with friends and walk through a couple terms. Operating leverage being one. I'm fascinated by what's happening in like Square, Capital One, companies that you don't think have exposure, right, to this. You think, well, they're just debit cards, Visa. You talk about the Gap, Simon Proper. So I want you to walk through with a couple charts why this unwinding's happening,
Oh,
and
yeah.
some other thoughts about the market.
So,
Everybody, Rob's the founder of Koyfin. So Rob, I'm going to let you drive, and I'll ask questions.
oh,
So
all
it's
good.
March. What's today? It's the market's
Mar-
been halted
March,
one
March 18th. Yeah.
March 18th. People are definitely. This is the day that the true unwinding is happening. And
So,
you, and you
so,
talked about something about this fear about why you think we're arguing about whether they should open or close the market. So why don't you dive in right there?
so first of all, I want to plug our research blog, koyfin.com/research. Put
Okay.
out a great piece this weekend on how to think about the current bear market, including previous bear markets, kind of where we are now. This is down 26% when we wrote this.
And
What
now
they've
we're down 36%.
we're down about, yeah, like 30, probably 30, 32, and just gives you kind of like a range of where we were in previous bear markets, and also what the increase was, what the bounce back was. The biggest takeaway from here is kind of not the decline, but it takes a long time to bounce back typically. So I think anyone, so this is weeks from the market trough, and you can see kind of the median number of weeks is 74. So it's very rare when you have these severe declines to really come back in a V shape. That's the biggest takeaway from this chart for me. And then the other thing that we highlighted,
Well, I mean, it just take you go back to that one more sec, my man.
yeah.
Thanks. So you're saying, so what are you saying? It's rare. It'll
So
take.
so the decline typically takes a long time in bear markets. Like we go down for a long time. It's not just whenever we decline more than 20%, only like
That's the all-time high, though, correct?
this is from when the market peaked, when the market started declining.
Yeah. Peak. So to get back there took 142 weeks from the decline? No.
Uh, so
No,
if we
sorry. It took 142 weeks for it to get to the bottom
for,
in September 29, 1929. Oh, you're doing average. Sorry.
so
Okay.
this is max, yeah. So if you look at the median, which is kind of like a good one to
Got
look at,
it. Got it.
so the median decline took about 69 weeks. So that's
Week.
yeah. So this is weeks,
Yeah.
and you could see like 1998 was much shorter.
Mhm.
But whenever these big declines happen, they just take a long time to play themselves out,
Yeah.
and then the bounce back happens.
We've only been at this 6 weeks, 4 weeks.
4 weeks now. Yeah, 4 weeks and nothing. So this stuff takes a long time to come through. So and then the other thing to mention is we have COVID cases on Koyfin, which you could plot. And so here, like what I thought was interesting in China, the Chinese market started declining in January, and it basically bottomed when they showed a decline in COVID cases. So this growth rate is.
How do you pull that up on? I've got my Koyfin open. How do I pull it up?
So if you have your dashboard,
Mhm.
I will share this dashboard with you of cases, COVID-19 cases,
Yeah. Okay. No worries. But
and
that's
and and so you could just click through. So here's China, here's
pulling
Italy.
that from.
What's that?
Where are you pulling that from?
So this is coming from World Health Organization.
Got it. So you guys put together a little extra work and pulled in that data.
Correct.
Thank
Yeah.
you. Okay.
Right.
Okay.
So these growth rates are really important to monitor. So the 5-day growth rate in Italy right now is 186%, and
Crazy.
it's not coming down, right? So for I think for the market at some point to get comfortable, this number will have to come down and have to
Isn't
show.
everybody staring at that number now? Therefore, it's not a number that matters at this point.
It's definitely a number that matters because everyone's staring at it, but no one knows when it's going to start coming down.
Okay.
So that's the
Got it.
important part. So that's so I'll share that link with you of cases and debts. And so
And how
these
are
are
you following the panic using Koyfin? What are your like go-to things?
yeah. So I'd say kind of like the three things to think about right now is we have a huge deleveraging, and the deleveraging is investor deleveraging, it's financial deleveraging, and it's operating deleveraging. And all three things are super important to track. So on the investor deleveraging, on the stock side, you're seeing it kind of like with hedge funds and with all investors just taking down their risk, and so the positions that were the most crowded are getting hit a lot. So, for example, if you look at a company like Charter, which was a big hedge fund hotel, this is a really stable company, obviously a cable company, and it's down. It's continuing to kind of nosedive. It's not showing those defensive properties as people
But,
as
but that just makes no sense. If it was a crowd, if the hedge funds are supposed to be smart, why are they all crowding into the same trade?
well because kind of like before this, this is a company that can deliver continued earnings growth with continued execution. So all the hedge funds love this company. It's a we don't have the hedge fund holdings on Koyfin, which we want to get, but if you look at the holders list, all the kind of TMT funds are all own the stock.
Okay.
Um,
And
yeah.
to continue on the deleveraging thing.
So that's one aspect on the stock level. Another aspect on the deleveraging is the deleveraging from macro funds, and that's really important because what's happening right now is you have a lot of macro funds or a lot of funds that have set up these risk parity strategies. Have you heard of risk parity before?
I have, can you explain it again?
Okay, super easy. Ready? All risk parity is you own bonds and stocks in some proportion. And the reason it works is so blue is stocks here, red is bonds. The reason it works is whenever there's a risk hiccup, whenever there's a crash, stocks go down and bonds go up.
Right.
Right. So it's kind of like your portfolio, except they weight the portfolio on a volatility basis and they reweight and all this fancy stuff, which they charge a lot of money for. But at the end of the day, they're long stocks and they're long bonds. And this is what Bridgewater does. Bridgewater is long stocks and long bonds. And that's why it's able to generate such consistent returns, because when stocks go down, they just weight bonds more and they're able to kind of hedge those two things off, right? And you could see that in like in 2012, when Europe had issues, bonds went up. You could see that in 2015, 16, when stocks went down, bonds went up. So it's a really diversified strategy. The problem right now you're having is that initially you had this bond rally, which worked, and now bonds are starting to go down. And so this is really bad for these risk parity funds because as both stocks and bonds...
There's been rumors that they're getting seriously liquidated. That would be the end of that trade.
So that's the end of that trade. So I'm guessing Bridgewater continues to continues to underperform because of this. You had a macro.
That could be a blow up because they could be liquidating themselves right now.
They could be liquidating themselves. You had a fund. You only had one.
How do I pull up that risk parity? That's a cool chart. Where do I get that?
So you just go to the regular chart and you pull up an SPY and you just add TLT, which is bonds, as a secondary series. Yeah.
Wow.
There's only one fund that kind of is known right now to blow up in Europe. It's called H2O. So H2O, what they were doing is they were long Italian bonds and short US bonds because of the spread. They thought the spread was too high. And when Italian bonds blew out because of coronavirus, they basically got caught. And some people say, I have no idea if it's true, that this kind of like massive run up was them unwinding their positions.
They were buying bonds.
So they were long Italian bonds and short U.S. bonds.
Yeah, they had to cover their U.S. bonds.
So
wow.
And they were levered in a massive way. It's these French guys who have these quant models and they have massive leverage based on these quant models.
Who gave them the money? Just rich people.
Rich people, and I believe what's that French? Natixis, I think is the bank, the French bank. I think they were.
So basically, that chart just explains the deleveraging going on. That's massive.
That's French bank in Texas. So this is the this was the banker of this hedge fund. Anyway, so this is the massive deleveraging going on the macro side. So that's on the macro side. Then on the financial side, you have obviously equities, you have credit, you have a massive deleveraging in credit going on now because of one, the spike in risk premiums, and two, because of what's going on in oil prices. Because a lot of these energy companies were the major issuers of credit in the past couple of years.
Yeah.
Right. So one way to look at that is on our corporate credit dashboard. We have all the kind of corporate credits here. So I'll just select U.S. high yield as a, oops, you're in the way here. And then we will, this OAS is basically the spread versus treasuries. Here. And so you could see this massive spike in spreads that's happening.
The last time it happened in 08, but there could be a massive, there could still be a lot more.
There could be a lot more. So you know, kind of like looking at this chart, the deleveraging and the repricing has a while to go before it kind of like matches some of these other episodes.
Okay, got it. So everybody's still early calling the bottom. Yeah.
So that's on the financial side, and you know, oil prices, just a big thing to watch here now. $20, because a lot of these U.S. energy companies just are not going to pull through this because they're not profitable unless oil is above $30 or $40.
Yeah. Is oil at $20? Is that what I'm saying?
Oil's at $20
today.
Yep.
Wow.
25%.
Wow. Historic.
Yep. And obviously you can, ETF to track for this high yield stuff is HYG for the high yield credit. And so that's kind of been massively selling off. And then even on the ag side, which is the aggregate, this is kind of the high grade credit that's been selling off as well, as people just use this stuff as
raise cash.
Trying to raise cash, absolutely.
Just deleveraging right now.
Just deleveraging, right? So investor deleveraging, financial deleveraging, and then the other deleveraging, which is kind of more hidden, is the operating leverage deleveraging.
This is what you were explaining to me, which is interesting because, you know, I've been nibbling on some favorite consumer brands, but they have so much operating leverage. You explained to me it's hidden whether they have debt or not.
Yeah, so a lot of these retail companies, they don't have a lot of debt, but the operating leverage or the obligations they have are in the form of lease payments. So they sign 5-year leases typically with malls or with real estate companies, and so they have to pay those rents no matter what. And it's the same thing if you think about it as financial leverage. You're basically taking on a liability and you have to make a fixed payment. So that's why companies like Gap are just plunging, right? Like they were down. They were down already coming into this.
E-commerce can't save them because of the operating leverage.
Right, because they have to. So even if they, let's say worst case scenario, they lay off all their employees, which I'm sure is happening to some degree, they still have to pay their rent. And if there's no sales, if there's no people shopping because it's prohibited or people are scared and they're staying home, that's where the operating leverage really flips for these companies. And so if you have a company, so if you have a company like Macy's, that, you know, came into this downturn on a shaky basis, that's why you have this decline.
For any retailer that was in trouble, this is the perfect storm.
That's exactly right. If you're a company like Target, which has a decent balance sheet and has done well into this crisis, you're definitely suffering, but you're going to make it through this.
So then why did Lulu fall in so fast? So if we pull up Lulu, which I just bought some.
Yeah, so I think with Lulu, it's you know, they've done well. They have, let's look at their balance sheet.
I'm saying it's still down 50% or 60%.
Yep. So yep. So you know, they have kind of $500 million in cash, which is great. Long-term debt is zero, right? So no debt. 500 million in cash. So, you know, depending how much sales fall. You know, their sales are
in now, and that's why it's only fallen 50%, let's say, and was doing so well.
That's why it's only fallen
very
50.
little leverage, but that's why I'm buying that. The other one but you're saying even like McDonald's has massive operating leverage. You know, I was buying some McDonald's and
So you have like if so we're just here in the market scatter plot. If I just pull up
okay.
the XRT ETF, which is the retail ETF,
And that could be the
uh,
other thing. People are just selling the ETF and just,
they're selling the ETF. But if you look at the performance here over the past month, which is a good proxy, so this is all the stocks in the ETF, and you can see here stocks that are down 80-90% over the past month.
place, yeah.
So children's space, some of these smaller companies that are important, but like Guess, Groupon, Signet Jewelers, Carvana.
Wayfair, aren't they just an e-commerce company? Pull up the Wayfair chart. That was always skeptical to me. Got to $100. Where is it now? $150.
So I think because they're like a furniture, right, retailer.
Yeah.
So I think because they're such high priced items and they probably have a lot of inventory, and just nobody's buying a house or refurbishing a house.
But 0% interest. So if they can stay in business, we'll pull up Restoration Hardware, for example, which I got wrong. And it's just endless bottom. I mean, endless.
That's right.
You can just see because it's a high priced item. And I'd have to check their balance sheet. Why don't we pull up their balance sheet while we're here? Are they out of cash or something?
So they don't have a lot of cash, and I believe they're pretty levered. Yeah, pretty levered. So
That's why.
yep.
Yeah. So they can go out of business theoretically.
Yep. So, just leverage during a time like this is just super toxic for any company. And that's why, with Boeing, the biggest problem here is that they just have such massive operating leverage. Think of all those hangars and those planes that they have to pay for. And if the airlines aren't going to be taking deliveries over the next 2 or 3 years, that's stuff they have to finance. And that explains why they had to draw on that facility and why people are just so scared too.
Yeah, this is when you find out that the company you thought was a software company like Square is really just a lender to retailers because it's doing so much worse than it's down, I don't know, 50, 60% in the last month.
Yeah.
And that's because it's levered to small business because it lends money or it's afloat. It's just incredible move. What is that?
60%. Yeah.
60% in a month. It's just a black swan. And then I look at Capital One, which is tied to, you said, the low.
Yep. So a couple of kind of like knock-on effects. So this is a credit card lender. There's only a few, but this is kind of more the lower end of the market. And so this is this is down 60% as well, and you can see that that's like really taking it back to
08 event.
Yeah. Another one that we talked about was SPG, Simon Property Group.
This one blows my mind. So yeah, and you're like, this feels like it's just, so basically the owner of all the biggest mall of all, the largest amount of malls. So it could go out of business.
You have to take a view on how long this is going to last. So this is going to last 3 years, and people don't shop. But this is as bad as 0809, right? They were down 70%. They're down 70%. And for a mall operator, for a real estate company, this is a 100 standard deviation move.
100 standard deviation.
It's something very high. I'm not sure what the exact value is, but.
And where'd you learn to do all this stuff? Just as a Goldman analyst?
Yeah, just kind of bouncing around on Wall Street in different jobs. That's kind of a process I'm looking at these stocks.
And that is pretty amazing. So you can see there's just, wherever there's leverage right now, it's getting unwound.
Yeah.
That's why cash is the only safe haven, I guess. You just got to trust your bank at this point. And how are the banks doing? Let's look at like Wells Fargo.
Yeah, so it's if we look at like XLF as a starting point.
Mm-hmm. Oh my goodness.
So obviously banks have just massive leverage, right? And it's the most. I really remember the first time I looked at a bank's balance sheet, because I always knew banks were levered, but you always forget how levered they are.
Uh-huh.
So if you look at Bank of America, um, just going to pull up financial analysis. So, I mean, these guys have $2.4 trillion in assets.
Yeah.
Trillion dollars, right? And they have $264 billion in equity. So that's 10 to 1 leverage.
Yeah.
Yeah. So, looking at, if we just go back to XLF, looking at the same way we looked at REITs. So just look at XLF here instead of the REITs, and we'll look at market cap versus the 1 month change. And you get, so a lot of these insurance companies are down 70%, 60-70%. You have these smaller regional banks that I think are more idiosyncratic depending on what their loan book looks like. And then you have some of the, it's interesting, some of the bigger banks like Citigroup, where's the Bank of America, they're actually holding in better than some of the smaller names, which is different than in 2009 when
Big bank took everybody.
The big banks took everyone out, exactly. So if you look at XLF versus KRE, which is XLF versus regional banks, and you can see here in 2007, like this was massive underperformance because the big banks were the ones that were in trouble. And now you're sort of having the opposite where the big banks are outperforming the regional banks.
Yeah.
Interesting dynamic. You and I were talking about kind of like what like how do you think about a bottom and stuff like that. And because you just have this scenario right now where deleveraging leads to more deleveraging, it's just a domino. You really need the government to step in and stop it. And that's what happened in, if you remember in 2009, the way that this.
Remember they shut the market though.
So, I mean, what happened was on March, just going to change this to 20 here. What happened was on here, this was SPX. Oh, sorry, I'm looking at 2009. Basically, the government said we are going to guarantee Citigroup's debt. So that was the bottom, and that's because that was really the thing people were scared about, is Citigroup going under.
Yeah.
And this was when they said we are just going to, before they were doing it in tranches, and they were saying like 10% and 20%. And when they really stepped in here and said, we're just going to put a floor under Citigroup and we are just going to be unlimited buyers of their debt, that's when you had the snapback and you're able to kind of reverse that.
Who do they have to save this time, do you think, if you were to speculate? They got to save them. They got to save the mall. Maybe some, like, who do they have? That's small potatoes. So who they have to save the hourly worker?
Yeah, look, I think this $1,000 or $2,000 check is going to be is one thing they need to do. I think going back to our initial conversation, I think the market needs to get comfortable on the coronavirus testing itself, so the healthcare implementation and how quickly they can get those testing kits out and widely available. I just spoke to my family today, and they one of my cousins is sick, and he wasn't able to get tested even though he's sick. So I think that's still an issue. But getting this healthcare issue resolved is one thing. I think stimulating the economy of putting money in people's pockets to spend is the second thing. And they will eventually, they've already started thinking about how to guarantee mortgage-backed securities and other lending. At some point, they will probably have to do that in the financial system for banks and other things, because that's where the massive knock-on effects are. If people start worrying about banks because they own so many assets, because that'll force deleveraging, that's the big problem. Look, if a bunch of restaurants go out of business, it's super unfortunate. And a lot of people will lose jobs, but it doesn't cripple the economy. But if banks go out of business and lending institutions go out of business because they are so intertwined, that becomes the big systemic risk.
So that continues to be the same risk as 08.
That becomes the same risk as 08. And, in 08, you just didn't have the restrictions on the economy growing, on consumer spending that you do now. I'm reading all these different estimates, but some sources, some valid sources that are reputable, are now saying half the U.S. is likely to be infected at some point. It just kind of controlling that peak and pushing that peak down.
Yeah. Interesting. Okay, so I appreciate it. Will you share this with me so I can share it for people? I think this will help, people understand the panic that's going on. I think you're covering it from, it's just a simple, it's not simple, but it's just people leveraged over years and years, just people that we trust with their money doing stupid things. Every advisor's been selling 70-30, 60-40, these same portfolios, saying they were uncorrelated, and they're all correlated.
Yeah, yeah, that's a huge issue when correlation just goes to one, and people panic sell, which causes more panic. It's just a very vicious cycle that doesn't depend on fundamentals. It's all risk and psychology, and that's why the VIX is at 90.
That's why the VIX is at 90. Okay, thanks for doing this. Share this with me, and I'll get it out today.
All right, thanks, Howard.
Okay.